Welcome to Human Risk, a podcast dedicated to the understanding of human behaviour as a risk. Here's your host, Christian Hunt.
Welcome back to another episode of the Human Risk podcast. In this series, I explore the idea of human decision-making as a source of risk. I speak to academics who can help us understand the science behind how we make those decisions, to practitioners who can help us understand ways we can help mitigate human risk, and to people with experience of human risk themselves. My guest this time, David Enrich, doesn't bring personal experience of the kind of human risk I'll be focusing on in this episode, but he has been researching it for a number of years. David is the finance editor of the New York Times, who has been looking into the story of Deutsche Bank. In his recently published book, Dark Towers, he chronicles how a conservative bank from a country famous for diligence grew aggressively to become the biggest bank in the world. You don't necessarily have to work in the banking industry to know that Deutsche Bank has been in trouble. Lots of trouble. I should at this point disclose that my interest in the firm isn't just as a human risk case study. I worked in its London office for a number of years, and so some of the people and dynamics David describes are more than just names and stories. But even I was surprised by many of the details he revealed. What David explores in his book is an astonishing catalogue of errors, misjudgments, failures, and horrors. In short, an extreme case study in human risk, which is why I was really keen to get him on the podcast to talk about what he's learned. What you're about to hear isn't just a tale of a bank that got things slightly wrong. It's a litany of failures. Perhaps most interesting of all to a contemporary audience are the stories involving Donald Trump. We cover that in our discussion, but suffice it to say that without Deutsche's financial backing, he might well not have found himself in the White House. As human risk case studies go, this is right up there. Whether you're a former colleague of mine who saw some of this in action, or someone who's never heard of Deutsche Bank, what you're about to hear is a remarkable tale. Please enjoy my conversation with David Enrich. So David, welcome to the Human Risk podcast.
Thanks for having me.
It's an absolute pleasure. And look, as I explained in the intro, I used to work for the firm that you've looked at. So fascinating from my side to know, how did you come to look at the story that was or is Deutsche Bank?
Well, I was in London from 2010 to 2016, and very shortly upon my arrival in London, the European financial crisis started brewing. And I was really kind of on the lookout for big banks in Europe that looked like they were in trouble. And Deutsche Bank was just the perfect example of that. It was one of the world's largest banks. It had a pretty good global financial crisis. But everyone I talked to, whether it was investors or analysts or academics or people in the banking industry, everyone felt like Deutsche Bank was this powder keg that had not yet exploded. And so, for a journalist looking for a good story, there's nothing we like more than something bad about to happen. And Deutsche Bank appeared to be something bad about to happen. So I started digging into Deutsche Bank probably like 2011 or so, I would guess. So I've been obsessing about this bank for nearly a decade now, which is probably not that healthy. But the more I dug, the more troubling stuff I encountered and the more cultural problems I encountered at the bank. And that's one of the things I just find really fascinating about major banks, but also just major institutions in general, is how the psychology of people at the tops of these organizations affects the psychology of people all the way down through the food chain. And that's what drives behavior. And that's what ultimately drives, we talk about corporate crime and fraud and just bad decision making. Those are human decisions. And that's something that I spend a lot of time thinking about.
And it's astonishing when you tell the story in the book, and what starts out as a very kind of vanilla, sensible bank builds into this thing, and it's not just one thing that happens; it's a whole sequence of events. And of course, coming from Germany, where you would expect to have very strong corporate governance, it's potentially even more surprising. If we sort of go back to the start of this piece, I mean, you tell a story of a very sensible, plain vanilla bank.
Yeah.
What went wrong?
Well, and I didn't even know any of this history at the time. This is history I've learned in the past few years, really. And I just kind of always assumed that Deutsche Bank was this big, reckless, kind of monstrous institution. But you're right. The bank was founded in 1870, so 150 years ago. And for its first several decades of existence, its primary purpose was to serve essentially as an engine of German economic expansion. So this is the dawn of the industrial era, and there were a lot of big German companies that were trying to spread their wings internationally, most famously Siemens. And Deutsche Bank played a leading role in helping companies like Siemens develop international presences and provide them with the loans and kind of the financial backbones to do that. And at the same time was providing financing for all sorts of other kind of infrastructure projects and development projects, in particular railroads, all over the world. And it wasn't really like a plain vanilla bank in the sense that it didn't have retail customers, for example. It wasn't out there kind of offering, taking people's deposits or making mortgages or anything like that. But it was a very narrowly focused, I think, kind of utilitarian bank that saw that Germany, if it was going to have a big part in the world as the world globalized slowly, they needed a leading international bank. And so it went along like that for about 4 decades or so, 5 decades. World War II comes and the Nazis come to power in Germany, and Deutsche Bank played an integral role financing them. So that was a pretty bad decade, to put it mildly. And then again, after the war, Deutsche Bank reverted to this role that it had been playing pre-war, which was really helping German companies and European companies do things that were economically beneficial. And so Deutsche Bank played a leading role in the reconstruction and redevelopment of Europe after the war. It played a leading role in advocating for things like the forgiveness of third world debts. So it was, for the most part, for most of its first 12 decades of existence, Deutsche Bank was a modest but positive force economically in the world. It did, with the minor Nazi exception, it was doing good things. And then it decided that it needed to get a lot more profitable, and that's where the wheels start coming off. And the reason it decided it needed to get more profitable, it wasn't purely just greed on the part of Deutsche Bank's executives. It was that in an era of globalization, starting in the late 80s, going into the 90s, investors all of a sudden went from kind of picking between 3 German banks in which to invest or 3 American banks in which to invest. All of a sudden, the world was much smaller. And if you're an investor sitting in, South Africa, you are not picking between South African banks or German banks or American banks. You can pick any bank to invest in. And obviously, as an investor, you're going to kind of, lean toward whatever is the most profitable institution. And at the time, the big Wall Street banks were just killing it. It was this era of deregulation, and it was just a real go-go era on Wall Street and to a lesser extent in the city of London. And so the big Wall Street firms were and the big banks in the U.S. in general were really doing a better job of attracting investor money. And so Deutsche Bank, to compete for those investor dollars, needed to become, or perceived a need to become, much more profitable, much faster.
And the path to that was just we'll go buy someone.
Well, it was initially, and so they made a small acquisition in the late 80s of Morgan Grenfell, which was this kind of venerable, kind of stodgy British investment bank. That didn't actually do a whole lot to move the needle. So in the mid 90s, they decided that they would start hiring some of kind of the bigger names on Wall Street. And the most important thing they did was in 1995, they hired a guy from Merrill Lynch named Edson Mitchell, who was this charismatic, kind of exuberant salesman at Merrill, who was also just very impulsive and a real kind of visionary leader, but not someone who had a very good sense of restraint. And Edson Mitchell and his little inner circle were essentially given a blank check to go hire whomever they wanted from all over the investment banking world. And so they spent billions of dollars very quickly, in like a year or two, hiring thousands of people from kind of the riskiest, most aggressive Wall Street firms at the time, whether it was Merrill Lynch or Bankers Trust or Lehman Brothers. And all of a sudden, Deutsche Bank started to go from being this really non-entity in the US and in the city of London to becoming, and it wasn't the leading player, but it was getting there quickly. And the bank really cemented its position toward the top at the end of the 1990s when it decided to buy a very aggressive and very troubled and cavalier American company called Bankers Trust, which was a $10 billion deal, which even at the time everyone thought was ridiculously overpriced. And all of a sudden, Deutsche Bank with this acquisition went from being a place that was still a German institution. They was still, German was the language spoken in the boardroom. The locus of power was in Frankfurt and to a lesser extent Berlin. And all of a sudden that was just flipped on its head. And it became essentially an American, to a lesser extent, an Anglo institution. The traders were the ones with the power. English became the official language of the bank. And it really, in the culture, the bank inherited with Bankers Trust was one where it was a very simple culture in a sense. It was, we are going to prioritize short-term profits above everything else. We don't particularly care about ethics and morality. We only slightly care about the rule of law. And we're not even really in it for our clients. And one of the Bankers Trust executives said something to a senior Deutsche Bank executive as the deal was about to close and remarked on how, we perfected this money-making system to such a degree that we don't even need clients anymore. And that was, when I heard that anecdote recounted to me, that was a very telling moment because, it's perverting the very essence of what a bank is supposed to do, which is, a healthy, safe bank plays a very central, important role in a well-functioning financial system and in an economy. But the core of that is that it's essentially taking people's deposits, taking the excess money that people don't have a need for in the moment, and redistributing that to the people who in the moment do need it. So taking people's deposits or other money and then lending it out through various different mechanisms. And that's a very healthy, important role for a bank to play. But when you view your position as not even needing clients, well, watch out. I mean, that is trouble. And that's exactly what Deutsche Bank became.
And people often talk about casino banking. I've heard you talk before around the fact that the casino bit's understandable, but it misses the key point here, right, which is that the individuals doing the gambling are gambling with the house's money rather than their own.
Yeah, I had that realization actually after the book was published, believe it or not, that because there is this very kind of popular framing, especially in the media, I think, that these reckless, out of control trading floors and the banks that have the trading floors are essentially casinos. They're just gambling. And bankers and traders always chafe when they hear that. They hate that because it makes it seem like all they're doing is based on luck and rolling the dice, when in reality they're so smart and have really figured out these systems, which is not really true. But it occurred to me as I was doing another interview, actually, and I was about to make the gambling casino analogy, and it occurred to me that that's, I go to casinos sometimes, and I always lose all my money because I'm not good at gambling. And it occurred to me that that's why casinos make money. They're profitable because the people playing in the casinos are not good at understanding the odds and managing their own risks. And the banks have figured this out. Traders go into these casinos and they're not losing their own money. They're not losing any money at all. In fact, there's this huge asymmetrical system built up where, if you are a trader and you make $1 million for your bank, your compensation is set up so that you get generally a proportion of that. So maybe you get 10% of that. So that means you get $100,000. And that obviously gives you a very powerful incentive to make as much money as you can for your institution. And so you'd think your interests are pretty well aligned with the institution. The problem is that in a casino, if you make $1 million, that's fine. But if you lose $1 million, you're out of the money. You're in trouble. You just lost $1 million. But at a bank, if you lose $1 million for your institution, you're not losing your $100,000 cut. It's not like you have to pay that back. You get zero. So there's this really skewed incentive where there's a tremendous amount of upside potential from taking big risks, and there's literally no downside potential. I mean, the only downside is that potentially you lose your job, but Wall Street and the city have just notoriously short institutional memories. And, you lose your job at one place, you get snapped up by another place. So there's if I could walk in a casino and know that the only thing that could possibly happen is that I make money, that would be a very different situation. And my wife would be much happier with me going to casino.
And the culture clash that you described between the sort of Deutsche Bank and we've all got this image of Germanic stability and sort of corporate governance and the kind of fast and loose things that were happening in London, particularly in New York. It seems to just to sort of run away from them. I mean, what's your sense of what was happening in Frankfurt in terms of allowing this to happen? Yeah. Because in essence, what you've got is a reverse takeover, at least culturally.
Yeah, that's exactly right. I mean, the bottom line is it's very popular within Deutsche Bank these days, and over the past probably 5 or 10 years, to blame these out of control Americans and Brits for the trouble that their institution got in. The reality is Frankfurt and the Germans who were running this place deserve just as much blame, in my opinion. They weren't the ones losing all the money and acting really recklessly, but they completely dropped the ball from a governance standpoint and from a kind of risk management standpoint. And they got so swept up in the allure of these quick, easy profits that they didn't oversee what was going on. And so they repeatedly essentially wrote blank checks to the leaders of the investment banking division to do as they please. And ultimately, in 2002, they chose as the guy to run the bank a guy named Joe Ackerman, who was very much cut from this. He was Swiss German, so he wasn't an American or a Brit, but he was still very much cut from this kind of trading mentality. And he was one of the predominant cheerleaders of all of these traders and sales guys who were turning this, fairly conservative institution into a much riskier one. And Ackerman took power in 2002 and just completely stepped on the gas and encouraged people. He set these really high profitability targets that basically meant that Deutsche Bank needed, in the space of a couple of years, increase its profitability 5-fold. And, that's setting goals like that has an anticipatable outcome, which is that people are going to cut corners. They are going to cheat. They're going to lie. They're going to break the law. They're going to abandon any pretense of ethics or morality or doing what's best for clients. And they are going to do what they're incentivized to do, which is to make money as quickly as possible and as much as possible, consequences be damned. And that's exactly what happened.
As this thing is going on, is there a sense that, was anybody in Frankfurt calling this stuff out, or are they just happy to go along for the ride?
There were moments where people would call it out. And there were moments when I think just culturally it was painful for some of the people who had been at Deutsche Bank for a long time in Germany and viewed their institution as this venerable German place. I think it was frustrating for them to see these Americans kind of running roughshod over everything. But at the same time, they were completely blinded by the profits. They liked making money as much as anyone did, and their compensation was based, at least in part, on how much money the institution was making. And so everyone got swept up in this. And it's very easy in hindsight to say, well, they should have seen this coming and they should have managed the risks better. But at the time, this was an era where, and this was happening at a lot of different banks, and frankly, not just at banks. It was really happening in the corporate world writ large. I mean, companies went from viewing their purpose in society as serving multiple constituencies, not just shareholders, but customers, employees, communities, things like that, to having a much narrower vision of what constituted success. And it was really defined almost entirely by shareholder returns and their stock price. And so Deutsche Bank was, I would say, kind of the leading poster child of that evolution. And I think it was hard in the moment for people in Frankfurt who, they're looking at what's going on in London and New York, and they're seeing all these profits coming in. They do not quite understand how the money is being made. But when they ask questions, it's like they're just they feel a little bit like they're being kind of a stick in the mud and are not really going with the flow. And clearly what these traders and sales guys and investment bankers have figured out is highly lucrative, and everyone's kind of doing it, and they're really just emulating the Americans. So really we shouldn't get in the way of this really profitable juggernaut. And in hindsight, boy, that was the wrong decision. But at the time, and even now, I think you can look back and kind of put yourself in the positions of those people, and it's a pretty natural human response. And you don't want to be the jerk who is spoiling the party for everyone.
Right. And I mean, the people you might have expected to say something would be regulators. What's the sense of the sort of the BaFin, the German regulators' perspective on what was going on?
BaFin was a cheerleader for the bank. It viewed, and again, this is not, I think BaFin deserves enormous criticism for its role in the Deutsche Bank catastrophe, but regulators all over the world, especially in the pre-crisis era, really just have blood on their hands, in my opinion. So BaFin viewed its role as not in any serious oversight capacity. It viewed its role as a guardian of the German financial system and the German financial industry to a large extent. And so Deutsche Bank was the crown jewel. It was really just even the crown. It was one of the leading German companies. It was the leading German bank. And BaFin viewed it, a big part of its mandate, as playing defense for the bank. And so when American or British regulators would come in and start asking questions about all the risks that were being taken, or the weird ways the bank was accounting for stuff, or the multiple occasions, many occasions of them or their employees apparently violating the law, BaFin would come in and just play defense. And so Deutsche Bank could use BaFin and basically say, listen, American regulators, listen, British regulators, instead of us just, handing over the information you want or allowing you to interview the employees you want, you're going to need to wade through this kind of maze of German bureaucracy with BaFin. And BaFin was very happy to play that role. And so, in reporting this book, I talked to a lot of regulators in both London and New York and Washington. And they all had kind of some variation on the same critique of BaFin, which was that BaFin and Deutsche Bank, in terms of how they were deflecting regulatory requests, were technically following the law, but they were doing it in a spirit that seemed clearly designed to basically hide from outside scrutiny. And BaFin was really just doing the bank's bidding a lot. And it's hard to, they always had like a legitimate legal protocol that they could cite for what they were doing, but and so they're following the letter of the law, but they were not following the spirit of the law at all. And again, in hindsight, the outcome is quite clear. I mean, this is a catastrophic failure of regulatory oversight that has done a great deal of harm to the entire world.
If we look at the sort of the crisis, I mean, they emerged relatively unscathed. And in fact, there are examples of people kind of quoting them and saying, how good they were because they survived the crisis, didn't need a bailout, which, of course, now looks like a ludicrous narrative. And what's your sense of how that happened?
Well, I mean, there are a few things. One is that a couple groups of their traders made very well-timed bets that the American housing market was about to collapse. And they made bets that would profit from that, and in some cases would accelerate that collapse. And so that made them billions of dollars. And that in the short term saved them. Deutsche Bank still lost billions of dollars in the crisis, but the fact that they'd also made billions of dollars, it really cushioned those losses. And so it allowed them to not sail through, but it was a much better crisis for them than it was for many other banks. And what we know in hindsight is that Deutsche Bank was also playing all sorts of accounting games and probably cheating on how it was valuing a lot of its assets in ways that if they'd been honest about that and more transparent about it, they probably would have been just as insolvent as everyone else. And look, they didn't require a taxpayer bailout, but they got a lot of financial help from central banks around the world, and they were indirect beneficiaries of all sorts of other bailouts because their trading partners and companies that owed them lots of money were bailed out by governments. So, but this is one of those kind of weird moments for the bank because it goes from its executives think we just skated through the crisis. Look how smart we are. Look how successful we are. And they just lose all perspective. And instead of a responsible group of leaders in a situation like that would have said, okay, we skated through the crisis relatively. And there was a lot of good fortune involved in that, a lot of luck. And yeah, we can pat ourselves on the back, but we should not get cocky right now. And in fact, what we should do in this position of relative strength, before it vanishes, we should do everything we can to take advantage of that strength to kind of solidify ourselves and, raise more capital, protect ourselves against future losses, clean up some of the messes that are still lingering on our balance sheets, really take strong defensive action to reorient the bank toward a kind of a safer business model. And if they had done that, man, this story just would have been completely different. The bank would not have become this emblem for corporate greed and destruction. It would have actually been a case study in good management and how to take advantage of, a lucky roll of the dice and really make that into a lasting, kind of systematic change for the bank. And instead they didn't. And now we look back, and the year or so following the crisis, when Deutsche Bank missed all these opportunities to strengthen itself and instead doubled down on a lot of the risky, aggressive decisions that they had been doing pre-crisis, it destroyed the bank.
And if we, as you were talking, I was thinking about the way you talk about the governance structures in the book, and obviously you've got this thing called the Vorstand, which is the board structure that they have there, and it's a classic German structure of a supervisory board and an actual board. I mean, the way you depict that, it was sort of structured in a manner that facilitated this whole piece and therefore possibly played into what you've just described. Is that a fair depiction?
Well, I think it's a little more complicated than that, actually. I mean, so the Vorstand, I can never figure out how to pronounce that, actually. And I think you actually might have pronounced it better than I did. But I'm going to call it the Vorstand because I'm American. So that's an outgrowth of the German experience with fascism in World War II. They decided to build these overlapping corporate governance committees that would essentially serve as a guard against this very powerful unitary leader. And so it was meant to kind of slow decision making and dissipate power within an institution. And I think it worked very well for a time at doing exactly that. By the 2000s, though, executives at the top of the bank, none of whom were German, were really using it as a way to deflect blame and deflect responsibility. And so, there's a management board member who is responsible for making sure employees complied with the law. There is one responsible for ethics. There is another one responsible for technology. There was another responsible for, I don't know, I'm just making stuff up at this point, but the divisions of power were so clearly isolated that if you're the CEO of the bank, the guy running all of this, you can plausibly say, well, the legal stuff isn't really my responsibility. My responsibility is revenue. And so it became a very convenient excuse, essentially, for people like Joe Ackerman and after him, Anshu Jain, who was his successor CEO, to say, look, my job is to make money. It's not to worry about all this other stuff. And anyone who would question, in particular, who would question Anshu Jain about this, Anshu would kind of laugh in their face and say, look, you just don't understand how German corporate governance works. And because I don't have responsibility for technology. I don't have responsibility for legal or compliance or things like that. My responsibility is to maximize revenue, maximize profits in a particular division of the bank. And there was a little bit of truth to that, but it completely neglected what was in the interests of the company in the long run. And so I think what started out as a well-intentioned and somewhat healthy corporate governance system ended up really exacerbating a lot of the worst impulses of some of the bank's leaders over time.
And you've talked about the way challenge was rebuffed. One of the things I think is fascinating is how many people you have spoken to in researching this. And there's a clear thread here that people take massive risks if they come forward within the organization. And, you've made it pretty clear that people who have spoken out and have kind of told the truth, have whistleblown on the situation, it's been to their detriment. And I think that's a really interesting dynamic.
Yeah, it would be kind of funny if it weren't so alarming. I mean, it's just like clockwork when people would raise their heads above the parapet and complain about, whether it was risk management or accounting or money laundering or compliance. Like time after time, people internally in the bank, whether they're high ranking or low ranking, and it even goes to stuff like lending to Trump. There were people who were warning repeatedly about, look, this guy has ties to organized crime. He defaults on all his loans, and they would get shot down, and they would walk away with the very clear impression that if they kept voicing concerns, not necessarily about Trump, but just about anything, that it wasn't. Not only was it going to fall on deaf ears, but they were likely to be penalized for raising all these kind of annoying complaints that were getting in the way of the profit-making juggernaut. And so there are a bunch of examples in the book of employees who are not really even like heroes. They're just people who thought they were doing their jobs properly. And part of the job, and this is part of the job, is to, when you see something going wrong, you're supposed to flag that to your superiors. And that's the way a healthy institution operates. And it's obvious why that is good for an institution, to be able to tolerate criticism and encourage people to speak their mind. Deutsche Bank, though, and I think this is partly a reflection of the psychology of some of the most senior executives of the bank, who are in many cases just riven with this deep insecurity and self-doubt and a need to project their own strength and autonomy on everything they did. And so there was this complete intolerance for criticism or dissent. And, a culture like that, weak, insecure leaders tend to surround themselves with weak subordinates and weak deputies who surround themselves with weak, insecure people. And that culture very quickly at Deutsche Bank bled down through the org chart. And so you had all these people who were just ultra sensitive to anything with a whiff of criticism. There's no tolerance for debate. And on the rare occasions that someone kind of bucked that culture and did complain and filed and lodged grievances with people up the food chain, or tried to stop what they perceived as risky or improper transactions or accounting or things like that, I mean, often they paid with their jobs.
And the book it starts with a suicide, and explores that, and then the individual there, you use it as a key to unlock some of the pieces. I mean, that individual strikes me as being somebody who wanted to do the right thing, and yet clearly, as you explain, couldn't kind of cope with the inherent conflict that presented.
Yeah, and so the guy is Bill Brooksmith, and he's an American who was raised by a minister and in the Midwestern United States, and he had a pretty good sense of ethics and principles and morality, and he managed to bring those principles with him into the banking industry, and because he was such a smart guy and was an expert in derivatives and risk management, he climbed up through the ranks of Deutsche Bank starting in the mid-90s when they started building out the investment banking division. And he was actually best friends with Edson Mitchell, the guy who was kind of the architect of the modern Deutsche Bank. And and Brooksmith rose up through the ranks while managing to continue to be perceived as essentially the ethical compass of the bank and the conscience of the bank. And he would say no to transactions. He would tell people to take regulators more seriously. He was trying his best in a very difficult period for the bank, and I think he failed. And in fact, he definitely failed, because you can look at the outcome at the bank, and there's really no doubt about that. And in January of 2014, he took his own life. And it became clear in the reporting of this book that at least part of what was going on in his head at the time that he decided to die was that he felt horrible about his time at Deutsche Bank and felt that he personally was to blame for a lot of the trouble that had happened, which I don't really think is a fair assessment on his part, but it's crystal clear that he had kind of internalized a lot of the problems at Deutsche Bank and was beating himself up over his inability to corral these problems or prevent them in the first place. And so Brooksmith becomes, for me, is really a symbol of how hard it is for someone, even with good ethics and a good moral code, to survive in an industry and in an institution that has just so fully abandoned the principles that he cares about. So it's a pretty sad part of the book, but I think it's powerful because it really shows how these institutions kind of chew up the people who are trying to do good.
The sense I had reading it was that there are lots of people in the organization know things aren't going well. There's probably very few at the right positions to stick their head above the parapet. As you say, they get spat out. And so this culture kind of reinforces itself, where the norm becomes the bad stuff and the good stuff is kind of pushed out, in terms of sort of the people and the way they behave.
Yeah. And I think there's a danger in making it seem like that's even just kind of the way it went and was kind of accidental. Like, this is by design. I mean, the bank's compensation systems were set up in a way to really incentivize bad behavior. And and people at the time could see in some of the ways that traders were getting paid that there was a very powerful incentive for them to be committing fraud. And there was no check on that bad behavior. And there was one moment in the book where a guy who's in risk management and accounting goes to this meeting with a bunch of other risk managers, and the head of risk management at the bank warns them that, if the bank were to become less profitable and if the bank's risk managers were to kind of start saying no to more transactions, the bank would become less profitable and there would be less money to employ risk managers. And so sending a very clear message to this kind of dumbfounded group of risk managers that you are not to blow the whistle too much. And no one really set out to commit a crime, but everyone was incentivized to push the envelope as far as they could possibly push it. And it's not like they just weren't paying enough attention. They deliberately set up the institution to be as aggressive as possible. And when you're encouraging employees to do that, should not be a surprise to anyone when the outcome is that a lot of them are violating the law.
Right. And of course, the topic I have to talk to you about is the Trump topic, which kind of, I think the story on its own would be amazing, but this just adds a whole additional dynamic, and don't even know where to start with it. But clearly it's sort of, when you talk about chasing business, they end up with him as a client because nobody else will bank him. And can you talk a little bit around how that happened and the sort of dynamics of that? And particularly the bit around where he's borrowing money from one bit of bank to pay back another.
Yeah, I mean, that's an incredible moment. I mean, so the bank started working with Trump in the late 90s, right, as it was kind of trying to make a name for itself on Wall Street. And look, this was a bank in America that no one had heard of, or no one could even pronounce its name, really. And so there was no way it was going to be able to get kind of the marquee, really good clients in the U.S. It needed, because those people those companies already had relationships with well-established banks. And why would Deutsche Bank be attractive to them? So they had to essentially go bottom fishing and go for unbanked clients. And Donald Trump at the time was the epitome of someone at the bottom. I mean, he and his casinos had repeatedly defaulted on their debts and burned banks up and down Wall Street. And so Trump was essentially off limits to the mainstream banking industry. Deutsche Bank was looking for people who were exactly like Trump. And so off they went together, starting in the late 90s. Hundreds of millions of dollars of loans go to Trump that basically allow him to reinvent himself from being this kind of failed, slightly clownish casino developer into a major player in the New York City commercial real estate market. And so that was a crucial step in the reinvention of Donald Trump. And this goes on for 15 years or so. And along the way, Trump defaults on a number of occasions on loans or debt from Deutsche Bank, and different divisions of Deutsche Bank along the way, as he defaults, essentially wash their hands of Trump. They say, we are not going to touch him anymore. And then, a couple of years later, another part of the bank pops up and says, well, we know that our colleagues don't want to do business with him, but really this looks like a pretty enticing profit opportunity. So we're going to go ahead and do it. And lo and behold, they do it. And then he defaults a couple of years later. And this really reaches the kind of perfect crescendo in around 2012 when Trump had defaulted on a huge loan from Deutsche Bank to finance a Chicago skyscraper in 2008. And there's litigation that goes back and forth because Trump had actually sued Deutsche Bank, blaming it for predatory lending against him. And so there's all this litigation that goes back and forth. And the result of that litigation is that by 2012, Donald Trump needs to pay back tens of millions of dollars they still owes Deutsche Bank on this defaulted loan. And so Trump needs, and at this point, Deutsche Bank is just completely done with Trump. There's no way they're going to touch him ever again, because not only has he defaulted on them, but he's publicly humiliated them. So why would you do business with him? And so Trump, through his son-in-law, Jared Kushner, is introduced to a woman in Deutsche Bank's private banking division in the U.S., which is a group that caters to the richest of the rich. And Trump says to the woman, Rosemary Vrablic, look, I would love to be doing business with you guys. And Vrablic, who is in the market for very wealthy clients, and her division is really kind of just trying to carve out a foothold for itself, not only in New York and in the US, but also within Deutsche Bank, where there's all these little fiefdoms that compete against each other. And what better way to kind of climb up the food chain than to land a billionaire client like Donald Trump? And so she and her, with the support of her superiors, agrees to reestablish a relationship with Donald Trump. And the first loan that they give Donald Trump is a $48 million loan that will allow him to pay back the tens of millions of dollars that he still owes another arm of Deutsche Bank for a previously defaulted loan. And that sounds weird and a little incestuous, and it is. I mean, there's no other way to think about it. I've covered banking for 15 or 20 years now, and I've never seen anything like this. And you do not normally have one arm of a bank loaning money to a customer so he can pay back a defaulted loan to another division of the bank. It's really bonkers. And it shows just how there was this corporate culture at Deutsche Bank, not only of disinterest in their clients' reputations and managing risks soundly, but also just there's this intense competition between parts of the bank where they were all trying to make money off of each other, and they weren't operating as one cohesive institution. They were operating as a dozen different little fiefdoms that were vying for profits against each other.
And then obviously Trump becomes president, and how does the story sort of move on there? Because clearly there's a whole load of interesting stories involving Russia and that piece of it, and they appear to be kind of up to their neck in certain aspects of that as well.
Yeah, and Deutsche Bank is up to its neck in all sorts of stuff. I mean, the Russia connection is interesting because Deutsche Bank has been in Russia for on and off they finance railroads for the Tsar. So they've been in Russia for a long time. And their motto essentially was, we will do in Russia what our customers want. And recently, in the past 15 years, what its customers wanted was to launder money. And so Deutsche Bank established a very lucrative business for itself, laundering billions of dollars for Russian oligarchs and other wealthy Russians, helping them get ill-gotten money out of Russia and into the Western financial system. And a lot of this was happening at the same time that the Trump relationship was going full force. And to such an extent that by 2016, so this is the summer of the presidential campaign, Trump is the Republican nominee for president, and money laundering compliance officers in Deutsche Bank's offices in the U.S. saw money going from the Jared Kushner's bank accounts, or his company's bank accounts, leaving the United States and going to wealthy Russians. And there was such sensitivity about this within Deutsche Bank that when the compliance officers, who viewed this as very suspicious, tried to file reports with the government about it, they were shot down. And predictably, when they started complaining about it, they were fired. And so this is, I think Deutsche Bank is still viewed by a lot of people in the U.S., in particular in Congress and in some prosecutors' offices, as potentially the key to understanding not just Trump's finances, but also any nexus that Deutsche Bank has between him and Russia. And it's a very kind of active, open area of investigation still. And, it's anyone's guess where that will actually lead.
And do you think this institution is salvageable in terms of sort of building something that might respond to an ethical 21st century fit for purpose organization, or is it too late for that?
I don't know. The Deutsche Bank has new management. They're trying hard. I believe that they're well-intentioned. They're trying to shrink the bank. They're trying to reorient it back toward its kind of roots as a primarily German institution and a European institution. And look, they've made some progress on that. I think it's possible it's too late, though. I mean, there's and it's not just the financials of the place, although they are a big mess. And there's a lot of questions about whether they even have a viable business model going forward. And so putting aside those, very important questions, I think there's actually a bigger one that might be even harder for them to fix, which is the place's culture. And you still talking, I'll date this a little bit, but as recently as last year when I was talking to people up and down the Deutsche Bank food chain, and this isn't people at the top, this is people a bit lower down and the ones kind of in the trenches, I guess. And, you talk to them and nothing's changed. They still view their job as to maximize short-term profits. People in positions where their job is to, be on the lookout for illicit transactions or bribery or things like money laundering. They still felt like they were under enormous pressure from their superiors and their superiors' superiors to essentially just look the other way at stuff. And so there's this deeply entrenched culture at Deutsche Bank that goes back decades now, where tens of thousands of employees have been kind of programmed to view their job as not just making money as quickly as possible, but doing so in any way possible. And anyone who gets in the way of that profit juggernaut is going to get flattened. And so it's very easy for executives at the top of the bank to say that they want the culture to change and we need to look out for clients. We need to follow the laws and adhere to regulations and stuff like that. But it's much harder to get that message circulating in an authentic way down through the troops when a lot of the managers, probably hundreds of the managers and kind of mid-level executives of the bank, were trained and conditioned under this prior regime where they have a very clear job and ethics and compliance and the rule of law are really not factors for them. So I don't know if the culture is salvageable. And if the culture is not salvageable, then they're going to have many more scandals in the years to come. And it's only a matter of time before regulators, I think in the US, the UK in particular, just essentially pull the plug on the bank. And if that happens, it's not salvageable, to be honest.
And if we look at the sort of peer banks that you're looking at, is this really the worst outlier? Are there other people with sort of similar skeletons that haven't come out? Not expecting you to name names.
Well, I think, look, the banking industry over the past 20 years has been this just wreckage of institutions that got completely out of control. It's a reflection of the banking industry going from a place that was really, it should have been acting not entirely like an electric utility or a water company or a gas company, but really should have been something akin to that. And instead became these huge profit centers that took over substantial portions of the American economy, the British economy, the German economy. And so they're all, Europe and the US are littered with these banks that got in all sorts of trouble and were just systematically violating the law at every turn. And so Deutsche Bank, in my opinion, is the worst of the worst. I think every major bank has been kind of snared in some pretty ugly scandals in the past 15 years or 10 years. Deutsche Bank has been at or near the center of just about every single one of them. And it ranges from money laundering to bribery, to tax evasion, to violating international sanctions, to even more kind of idiosyncratic stuff. Like the Deutsche Bank was the only bank ultimately in the past 6 years willing to do business with Jeffrey Epstein. And that's that to me is one of the most telling kind of examples here, because it just shows this complete apathy about who they're doing business with and how they're making their money. And that's an interesting example also because no other American bank or any bank really would touch them, and Deutsche Bank wouldn't. So that to me stands out as kind of emblematic of just the unique badness of Deutsche Bank. But sure, there are thousands of other banks that have done awful stuff, and just because Deutsche Bank's the worst doesn't mean that those guys,
everybody else is good. Right?
It's a toxic combination of Deutsche Bank of they're huge. They're hugely ambitious. They're essentially backstopped by the German government, and they were overrun by this just incredibly cavalier, toxic culture. So it's a bad mix.
And what would your message be to regulators to kind of clean this? Do you think regulators have shifted enough to be able to stop the next one of these, or have they got some catching up to do?
I think regulators need to get a little more courage, honestly, and recognize that part of their job is obviously to maintain the stability of the financial system. But actually, in fact, that's probably the majority of their job. But there are different ways to do that. And I think the prevailing attitude in regulatory circles has often been that keeping quiet about things is the best way to maintain stability. And I understand that. And you don't want bank regulators out there, causing huge panics and bank runs everywhere. On the other hand, the policy of just kind of downplaying things publicly, I think in retrospect has been really toxic. I mean, one of the things I found in the reporting for this book was at the Federal Reserve, back in the early 2000s, there was a pretty severe money laundering case that they busted Deutsche Bank for. And Deutsche Bank executives who I talked to at the time said that they were kind of bracing for a huge penalty in the $100 million range. And instead, the Fed came at them with, I don't know if you can hear my kids in the background yelling.
I can. It's adding charm to the podcast.
Yeah. Instead of giving a severe punishment to Deutsche Bank, the Fed essentially looked the other way and did this little kind of very anodyne written notice asking them very nicely to not violate money laundering laws in the future. And sure enough, they continue to violate money laundering laws. And the interesting thing to me is that I talked to executives inside the bank who said when they got that very kind of benign order from the Fed, instead of a monetary penalty, they viewed that as, this really doesn't matter that much. No one's going to come down on us. And so I think regulators need to recognize that they need to be careful with their words and should not be, fanning the flames of panic all the time. They need to do a much better job of creating some sort of deterrent system and creating real consequences for bad behavior. And honestly, I think the bigger issue is with prosecutors as opposed to regulators who have, with a few notable exceptions, have just completely failed to even try to hold senior executives criminally accountable for the actions of their institutions. And there's no better way to sow fear in the hearts of executives and to really change their behavior quickly than to make them think that they could be handcuffed and they could lose their freedom. I mean, there's just warning them that they might lose their jobs or might be publicly embarrassed is just manifestly not worked. And I think that putting the fear of jail in some people's hearts might help change behavior quickly.
I think that is a fantastic note on which to end this. Thank you so much for being on the podcast. It's been an absolute revelation. The book Dark Towers is out now. Clearly, I wouldn't have had you on the podcast if it wasn't highly, highly recommended. Thank you so much for the work that you've done in exposing this, because I think it really is it's a demonstration, I think, of in a world where journalism isn't always delivering what we need and expect. It's an illustration of the high quality that we need, I think, at a time like this. But secondly, for a fascinating human risk tale as well, and for being on the podcast. Thank you so much.
It's my pleasure. Thanks for having me.
So that's it for another episode. My thanks to David for appearing and to you for listening. David's book Dark Towers is available now, and you'll find links to that in the show notes. If this is the first time you've heard the Human Risk podcast and you've enjoyed it, do subscribe wherever you normally download your podcasts. If you also had a moment to leave a review on that platform, it helps me raise the profile of the show and continue to attract the kind of high-quality guests I've managed to get thus far. At this time, I'm releasing more episodes of the podcast than normal, so you won't have to wait long until the next one comes along. And don't forget there's also the Human Risk newsletter, details of that in the show notes. I'll be back very soon with another episode, but for now, please stay safe, remember to wash your hands, and be kind to each other. Thank you so much for listening.